Hello and welcome. This is Helaluddin Ahmed, and let's talk about relevant cost for decision making in managerial accounting. Every decision involves choosing from among at least two alternatives. In making a decision, the cost and benefits of one alternative must be compared to the cost and benefits of other alternatives. Costs that differ between alternatives are called relevant cost. Distinguishing between relevant and irrelevant cost and benefit is critical for two reasons. First, irrelevant data can be ignored, saving decision makers tremendous amount of time and effort. And secondly, bad decision can easily result from erroneously including irrelevant cost and benefits when analyzing alternatives. To be successful in decision making, managers must be able to tell the difference between relevant and irrelevant data and must be able to correctly use the relevant data in analyzing alternatives. The purpose of these topics is to develop these skills by illustrating their use in a wide range of decision making situations. Only those costs and benefits that differ in total between alternatives are relevant in a decision. If the total amount of a cost will be the same regardless of the alternative selected, then the decision has no effort on the cost. So the cost can be ignored. An avoidable cost is a cost that can be eliminated in whole or in part by choosing one alternative over another. Avoidable costs are relevant costs. Unavoidable costs are irrelevant costs. Two broad categories of cost are never relevant in decisions. These irrelevant costs are: number one is sunk cost and number two is future costs that do not differ between the alternatives. A sunk cost is a cost that has already been incurred and cannot be avoided regardless of what a manager decides to do. Sunk costs are always the same no matter what alternatives are being considered. Therefore, they are irrelevant and should be ignored when making decisions. Future costs that do not differ between alternatives should also be ignored when making decisions. In managerial accounting, the terms avoidable cost, differential cost, and incremental cost and relevant cost are often used interchangeably to identify the costs that are avoidable in a particular decision situation and are therefore relevant. These steps should be followed. The first step will be eliminate costs and benefits that do not differ between alternatives. This irrelevant cost consists of sunk cost and future costs that do not differ between alternatives. And the second step is use the remaining cost and benefit that do differ between alternatives in making the decision. The costs that remain are the differential or avoidable cost. Decisions relating to whether product lines or other segments of a company should be dropped and new ones added are among the most difficult that a manager has to make. In such decisions, many qualitative and quantitative factors must be considered. Ultimately, however, any financial decisions to drop a business segment or to add a new one is going to hinge primarily on the impact the decisions will have on net operating income. To assess this impact, cost must be carefully analyzed. Separate companies may carry out each of the activities in the value chain, or a single company may carry out several. When a company is involved in more than one activity in the entire value chain, it is vertically integrated. Vertical integration is very common. Some companies control all of the activities in the value chain, from producing basic raw materials right up to the financial distribution of finished goods and provisions of after-sales service. Other companies are content to integrate on a smaller scale by purchasing many of the parts and materials that go into their finished products. A decision to carry out one of the activities in the value chain internally rather than to buy externally from a supplier is called a make or buy decision. Quite often, these decisions involve whether to buy a particular part or to make it internally. Make or buy decisions also involve decisions concerning whether to outsource development tasks, after-sales service, or other activities. Joint costs are irrelevant in decisions regarding what to do with a product from the split-off point forward. Once the split-off point is reached, the joint costs have already been incurred and nothing can be done to avert them. Furthermore, even if the product were disposed of in a landfill without any further processing, all of the joint costs must be incurred to obtain the other products that come out of the joint process. None of the joint costs are avoidable by disposing of any one of the products that emerge from the split-off point. Therefore, none of the joint costs are economically attributable to any one of the intermediate or end products. The joint costs are a common cost of all of the intermediate and end products and should not be allocated to them for purposes of making decisions about the individual products. It is profitable to continue processing a joint product after the split-off point so long as the incremental revenue from such processing exceeds the incremental processing cost incurred after the split-off point. Joint costs that have already been incurred up to the split-off point are always irrelevant in decisions concerning what to do from the split-off forward. And that's all for now. Thank you.